Welcome everyone to the first quarter and
in a couple days
monthly quarterly commentary. So obviously normally we get together and we talk about what happened during the first quarter, a little bit about any kind of changes to the portfolio, things that we're seeing in capital markets, what happened, and as I'm sure most of you are going to be watching this video are very well aware of, is that on April 2nd, the Trump administration announced a significant shift in economic policy and the way that they were going to implement trading agreements with our foreign allies and foes. And it was a particularly harshly received by the markets, in part because it was, and I think kind of the consensus was, this program was well outside of the mainstream thought of what the Trump administration would do. It involved not only reciprocal tariffs, which the market had very much priced in, but also this idea of if you have a trade deficit with a particular country, that was the sign of the United States government being taken advantage of. And so you had very aggressive tariffs being put on, and the aggressive tariffs were followed by very aggressive rollout by the Trump administration and the likes of Commerce Secretary Howard Lutnick, Chief Presidential Advisor Peter Navarro, who was kind of the architect of these tariffs, and the Treasury Secretary Scott Bessent, who, in addition to President Trump, came out and basically had said that they intended to roil markets. They intended to reorder trade, and that they were very committed to these tariff regimes. And that was, it played out over the last several days. And even while the United States Trade Representative was testifying before Congress about 2 hours ago, maybe a little bit less, President Trump posted on social media that he was going to give a 90-day window,
off to the races,
a 90-day freeze.
Yep.
And so we wrote a lot about this quarterly letter, and what we're going to talk about are ways, are kind of what we saw in the last 6 or 7 days, and how it relates to not only our approach on wealth management, but what we think is the best approach, and one that allows you to weather really difficult times. What's going on in the market is I think one of the things you see very few times over 15, 20 years. So to give you an order of the magnitude of what's going on, the S&P 500 at one point was up 8.5% today, after being down, I think, 1.2% to start the day. So you had a 1,000 basis point or a 10 percentage point swing. That kind of volatility, we saw that in the interceding 4 days since what was dubbed Liberation Day by President Trump. So, Sean, I want to introduce the title of this, and then I want you to talk about the reaction to broad markets. But the title of this piece is "Everyone Has a Plan Until They Get Punched in the Mouth." It was a phrase that became incredibly popular when former heavyweight champion of the world, boxing champion Mike Tyson said it. There was an explicitive in there, since this is
we'll leave that
out because we obviously want children and adults alike to watch this video. But we got punched in the mouth on Liberation Day.
Right.
It was something that was very much unexpected. It was the worst case scenario. It was actually even worse than the worst case scenario from what the Trump administration said they were going to do from a tariff perspective. So, Sean, why don't you recap what happened prior to
in the last couple of days,
prior to President Trump's tweet, and we'll talk about that following. But the reaction to the markets.
Yeah, so I mean, we came into Wednesday, into Liberation Day, with, I say, according to plan, right? Diversification was working. U.S. equities had a little bit of softness. Not unexpected, because we had 2 stellar years before that. International was providing an exceptional diversifier role within that equity space, up in the positive territory year to date through the end of March. And then bonds as well were doing basically their job, what we expected of them, up 2% going into Liberation Day as it's termed. again, like what you said, tariffs came in way higher, way more extreme than I think markets originally anticipated. Sure, they might have already priced in 10% across the board tariff. Then we got the reciprocal tariffs, and then the way they kind of came up with the tariff numbers kind of shocked markets. And then I think what was most shocking to investors around the world and to our clients most likely is the way that capital markets responded in a matter of 4 days. Right? We had one of the worst 3-day U.S. equity spells that we have seen in over the last 20 years. Haven't seen volatility like this since COVID. Mm-hmm. But basically what we saw, right, was U.S. equities and equities across the board really just sell off. At some points, the S&P 500 was down 10% in a matter of 2 days. Mid caps and small caps were down more than that. International markets, which were providing to be great diversifiers in the equity space prior to Wednesday, down 8% in only a matter of a couple of days. And so really, as you had already said, right, the reaction from capital markets was really extreme, but I think it was a reaction to an extreme measure from the administration.
Yeah, and I think it goes to what we've said from time to time, which is that the markets are really unpredictable, mm-hmm. and I think to try to trade, right, and I think we'll see you see, well, can you trade around these things? And there was no indication that President Trump was going to issue that message on social media. The United States Trade Representative for 2 hours today was defending the implementation of the tariffs. Yeah. And then when the news hit, was asked a question and didn't have the answer to it.
I mean, prior to today, the administration said these could be, not for sure, but could be permanent tariffs. So we just don't know what's going to happen.
And I think that uncertainty is, that uncertainty hit portfolios. And the philosopher king that Mike Tyson is, that quote is, to me, is it's one that's both instructive and incredibly valuable to always to keep in your mind. And I think what I tried to express in the quarterly letter was that you never know when you're going to get punched in the mouth. As you pointed out, 2023 and 2024 were great years. Mm-hmm. 2022, inflation was running rampant. Yep. It was very difficult. 2020 and 2021, they both ended up being really good years. 2020, we had to go through COVID, but mm-hmm. it finished being a great year. And so it comes down to, how do you react? Like, what is our plan?
Right.
And our plan has always been one of going back to fundamentals. And fundamentals, it starts with doing the little things well when markets are really good. It's about reinforcing where a person, where our clients are at, and their very specific financial plans, their goals and objectives, which are different than, we don't have any two clients that are the same. And while a lot of our portfolios have the same themes, mm-hmm. no two portfolios are alike, because no two people are alike, right. And two families are alike. And so it's going over those financial plans. It's going over, is my estate plan is it in line with where current estate and tax laws are? And on the portfolio perspective, is the portfolio growing in line with our financial projections? Is it doing the things that we expect it to do? And you go over those results with clients in meetings, and sometimes it might just be a 5 to 10 minute check-in on the financial plan, but it creates muscle memory. Mm-hmm. My plan is I'm on the right path. My plan is integrated, right? Tax, estate, financial planning, investments, all coming together, so that when you do get punched in the face, and we did, and it was difficult it was really difficult to understand what was going on, even opine on the tariffs prior to their implementation, because the Trump administration kept moving the goalposts. So they were moving around. They did Canada and Mexico first. Mm-hmm. They did some things on China, but their policy kept evolving. And I think what we did was stick to the fundamentals, not make any rash changes. And then when you get this piece of news, after you absorb the initial blow, then it kind of comes back to checking in with clients, checking their financial plan, making sure that the near-term cash reserves are taken care of. Those kinds of reassuring messages allow clients to get through the tough times to get into kind of calmer waters. And I think one of the things that we can point to as we'll call it like an emotional release valve for clients, something that we point to as a lever, we call it a lever to pull on for returns, is our commitment to fixed income.
Yeah.
And I think, Sean, maybe walking through, we've stayed tried and true to it, even despite kind of rising markets, not chasing the growth tech trade, but just sticking to those fundamentals of believing that fixed income has a place in portfolios.
Right, and this kind of covers multiple years, not even just in down years when the fixed income really true ballast of the portfolio, but it's right. Are we rebalancing in the good years, in the 2023s, the 2024s, keeping fixed income in the portfolio where maybe you're only getting 2 or 3%, and U.S. large caps are giving you 15%, doesn't look as sexy, but then it's really in quarters like this past quarter and 2025 as a whole so far. Is fixed income again is reminding us this is the role I play. I'm almost like a tortoise, right? Slowly but surely kind of moving our way through returns. And so, fixed income year to date is up about, again, 2%. Again, not gangbusters,
No.
but being, like I said, the ballast of the portfolio and being reliable for client portfolios whenever volatility does come into play.
And I think when we sit down and we review this as an investment team with our advisors and then communicate with our clients, the tariff regime, you have to go back to the late 1800s, early 1900s. I feel pretty confident. I think the world's oldest person is like 110. So no one was around the last time tariffs were this high. It was President McKinley, who was an Ohio guy like myself.
Represent.
Yeah, okay, have to represent the kind of the Akron-Canton area where he's from. And I think but we didn't have any historical precedent for this, but we have had other disruptions that have happened. And I think for us, those disruptions, those dislocations, those times where you have a 100-year pandemic, the world closes down, it feels like the walls are just closing in on you. It's a good time to take a deep breath, because investors have historically, every time the quote that gets thrown out, this time is different, or you feel the need to make an emotional response, right, to the market, you're typically not rewarded if you are just picking flight over fight. And in a lot of cases, investors, they get rewarded during these times for doing one of two things. One, staying the course. I've got a really good financial plan. I'm dollar cost averaging into the market every 2 weeks in my 401k. I know that my advisors have been dollar cost averaging into the market.
Yeah.
Or I have this portfolio. I know that if I stick with it, my goals and objectives are in place. So I don't do anything, but I kind of, what we call white knuckling up in Northeast Ohio, when you get a snowstorm and you're holding on to the grip so tight of the wheel that you can see your own knuckles, you white knuckle the portfolio through. Or you kind of do a combination of the white knuckle, adding a little bit in, being willing to say the market's for sale. I don't know if it's going to go up in the short term, but over the long term, markets historically go up.
It's like, well, what does Warren Buffett say? What's his famous quote?
Be greedy when others are fearful, and be fearful when others are greedy.
Right.
And that I think to us is something that's really important. And there are times, there are a handful of times every 20 years where the market is going to allow you the opportunity to be tested. It is going to, and sometimes I'll go like Lehman's bankruptcy, or Fannie Mae and Freddie Mac getting put into conservatorship, where you're like, that makes sense. Or the flash crashes where you just have a random stock market error or bond market error that causes the market to go limit down. What happened in 2010 and 2018, where in the case of the flash crash, it didn't make sense. You're kind of just throwing your hands up in the air like, what is going on?
Yeah.
And then the case of Lehman filing for bankruptcy, or Fannie and Freddie getting taken over by the federal government, it makes sense. You understand why there's volatility. But most times you're kind of in this mushy middle, right? Where it's COVID, it's the tariff turbulence, it's a inflation in 2022. There are these times where you're in that mushy middle, and you get tested, and that's where having a good plan, focusing on the fundamentals, that gets you through these times. And it's hard. In a lot of cases, this portfolio, it's a combination of your life's work. It might be a small inheritance that you got from your grandmother, your grandfather, your aunt, your mom, your dad, your brother. And you're looking at that, and it's hard to see the numbers going down. And that's something that we never take for granted. When markets go down, it's really easy to talk to them about buying opportunities when it's not your money.
Right.
And I think that there's a empathizing and understanding with you all on the decline of the portfolios, but also helping you understand that it's only a realized loss if you sell out. That if we continue to talk, we continue to work the problem, we continue to revert back to the financial plan that's on pace, that your distributions are met, that cover your expenses, it allows you to get to where we are today. And Sean, maybe if you could tell the folks, you can kind of pull up where it is on your computer to give them a kind of a live update of where we are at 15 minutes past the hour, 15 minutes past 3 o'clock, on Wednesday the 9th. But it allows you to get to the point where we can talk about where the portfolio, where some of the major indices are today.
I mean, today alone, right? Mid caps are up over 7%, small caps kind of following in line there. Large caps up 6.5%. International is up 5.7%, right? Basically erasing all of the negatives that they had going into today, right? International was down this morning at some point minus 4%, and now we're in the positive territory year to date. So it kind of really shows, right? We're long-term allocators, we're not short-term traders, right? And sticking to the plan in both the good times where it might be easier to do, and in the bad times in today's, like the last few weeks, this is where it really adds value to stick to that plan.
And I think it's the power, like you said, the power of diversification. Diversification helps you have a plan, helps you deal with getting hit, getting punched in the mouth. And so it's hard. We certainly planned on coming in here and talking about the first quarter and how diversification was certainly benefiting us, but in ways that international equities, fixed income was positive. U.S. equities were taking a breather. Mid-cap stocks were outperforming large and small. It was a different kind of diversification conversation that we were going to have. The key through line through it all was having a plan, being diversified, and then being able to have a relationship with your advisor where we're calling you, or if you call us, we take the time to walk you through, to reassure you. You get to a day like today, and we don't know what tomorrow is going to bring, right? This is getting posted. This is getting recorded on the 9th. We don't know what's going to happen the 10th or the 11th. But what we do know is if we stay connected, if we get back to the fundamentals, that's going to help us deal with the very, very volatile seas and get us into calmer waters. Get that ship into port. And so, really grateful for those of you that we are fortunate enough to call clients. We're so grateful to be able to work with you. For those that are friends of the firm or potential prospects, we look forward to talking with you all in the future about how we helped clients kind of get through the volatility, some of the things that we did in the portfolio. And to end on a high note, tomorrow is the start of the Masters. It's sunny outside. We've got the yellow Masters Cup here. Here's hoping that the start of the first golf major of the year is a sign of good things to come in markets and portfolios. So until the second quarter commentary, Sean, thank you for joining as always.
Until next time.
Everybody's got a plan until they get punched in the mouth.
That's right.
We'll look forward to speaking with all you soon. Thank you.